The next thing, which is extremely important, and if you get nothing out of this video, this should be the point that you get: pay off high interest debt. Hey guys, welcome to my channel. My name is Angoya and I make personal finance videos. If you are somebody who has just started thinking about investing in the stock market, you don't know what to do, or some of the things that you should put in consideration before you buy your first stock, this video is for you. If you're new here, welcome, and please hit the subscribe button so that you're notified when I post a new video. And if you're a returning subscriber, thank you for being here. Make sure you like and share this video so that a lot of people can benefit from it. If you've been anywhere on the internet the last couple of years, I'm sure you've seen everyone and anybody talk about the stock market, from really just witnessing the impact of COVID-19 on the market to cryptocurrency and the meme stocks and like all these technology companies and the volatility. As a result of those activities, I think that a lot of people have gotten interested in the stock market, which is exciting and amazing for everybody in the economy. But I know that it can be so scary and daunting to really just think about buying your first stock. I've been there. I have an accounting and economics background. I'm a CPA, I work in finance, but still, I really had a hard time trying to invest in the stock market and educating myself beyond what I had learned in school. So in today's video, I'm going to talk about some of the things that you must put in consideration before you buy your first stock. And even if you've gone ahead and bought your first stock, you still have to think about these things because I think they are very important to your overall financial well-being. The number one thing is why. Why now? Why the stock market? And why do you think that your financial position allows you to put your disposable income into the stock market? Are you just thinking because it's 2022, everybody's talking about meme stocks, everybody's talking about cryptocurrency, you want to be part of the conversations, then you should and must invest in the stock market? I don't necessarily think that that is a bad idea, but we have to be realistic. It has to be more than that. Being a part of these conversations is great because it allows you to learn. But keep in mind that even though these people are talking about these things, some people really just go on social media and repost what they've had, or they just, post things that they do not even understand. So if you're going to really base your investment decisions based off of what you're seeing on your feed, it might not be a great idea, because at the end of the day, the money that you're putting in the market is yours, and if it's a bad investment, you're the one that's losing money. Two, I just think that you should use social media to educate yourself, to learn, and I think it's really just a great tool for you to keep abreast with what's happening in the financial world. So don't base your decisions off of social media. Being influenced is good because it might actually push you to act on what you should be acting on, because it's probably time that you started investing, but you have to keep in mind that that cannot be the main reason why you need to get in the market. The second thing that you have to put in consideration is, do you have an emergency fund? I don't think that it's necessarily wise to start investing in the stock market if you do not have an emergency fund, for several reasons. Ideally, you should have 3 to 8 months worth of your living expenses before you start investing in the stock market. Once you have your emergency fund built up, then you can start investing in the stock market, and you can actually allow that money to grow, because in case of an emergency, you have a fund that can cater for that. I created a video about emergency funds and how to think about them. I'm going to link that video right here. You shouldn't really be investing in the stock market if you don't have an emergency fund, because what's going to happen is, in case of an emergency, you're going to run to your stocks and you're going to sell them probably at the wrong time, and the overall result is that you're going to lose money, and it's just going to really mess your financial situation even further when you thought that you're trying to do something good for your financial situation. So have an emergency fund so that you know that in case of an emergency, your stocks can keep growing and you have a fund that can take care of your emergency. You don't want to be selling to pay rent or selling to take care of your lifestyle, that just beats the point of investing in the first place. The next step is that you have to evaluate your risk appetite. Investing in the stock market is, somewhat risky, and chances are you're probably gonna lose your money on some stocks. You're gonna make money on some other stocks. You might even out. You might end up, in the negative. You might end up making money. You need to understand the type of person you are when it comes to risk. There are people that have a really high risk appetite, and those are people that are willing to make risky trades and like buy very volatile stocks and in large amounts, and they probably will make a lot of money off of that. High risk, high returns. There are people that are in the middle. I am personally kind of in the middle. I like to play on both sides, and that's okay. But there are also a lot of people that are risk averse who would rather just think about investing in like very low risk stocks like mutual funds and index funds, and that is totally okay. So before you get into the market, you need to understand like how you think about risk. You can't just go into the market and you are somebody who does not like risk at all, and then you go and start buying things that are really risky, and you probably end up losing your money and hate the stock market and start saying how it's a scam. It's not a scam. You have to know yourself. You have to know your risk appetite, and there are tools online that can help you. Like you can go and answer questions to determine your risk appetite if you actually don't know. Take advantage of those online tools. Check your risk appetite and then start thinking about your investment strategy. The next thing, which is extremely important, and if you get nothing out of this video, this should be the point that you get: pay off high interest debt. If you have credit card debt, if you have loans that are charging you 10, 15, 20%, please pay that off first before you start buying $2,000 worth of stock, because if you're not paying off your high interest debt, you're basically losing money. That's what I mean. On average, the S&P 500 will give you a 10% return on your investments a year, but credit card debt is like 24 to 25% in interest every single month. So if you have this debt that you haven't paid off in like 3-4 months or even a year, you are making less money than you're losing. So to pay off your high interest debt, because that is actually bad debt, and then once you're done paying that off, it will be easier for you to make investments and also to borrow money for good debt, like borrow money to buy a house, borrow money to start a business. That is good debt. But if you have credit card debt and you're not paying off your credit card, that affects your credit score. That also affects your ability to actually have good debt. If you have loans that you're not paying off, you're probably gonna go bankrupt, and then that just really messes your financial situation. So you have to be wise and pay off your bad debt. Once you're done with that, then start investing in the stock market. The next thing is you have to think about the stock market as a long-term investment strategy. You cannot take the full advantage of the stock market if you are thinking about it from as a short-term investment vehicle, for a variety of reasons. One, if you live in the United States, if you buy and sell your stocks within a year, the short-term capital gains that you get on those will be taxed at the ordinary tax rate. And so if you are in a higher tax bracket, you're going to pay much more taxes on those capital gains. But if you wait for more than a year, then you have long-term capital gains, and those are taxed at a lower tax rate. The next reason is that when you are buying stocks, you're essentially looking for companies whose stocks you think and assume are undervalued, and you think that over time their value will go up, their stocks will increase in value, and then you make money off of that growth. But if you buy your stocks today and sell them the next 4 months, these companies have not had enough time to grow in value. So you want to be the type of person who buys stocks in companies that you really believe in and love, or probably products that you use, whatever influences your decision to invest in a company, and then give that company time to grow and become more valuable. That is how you actually benefit from the stock market. The last thing that you have to keep in mind is to ignore headlines and come up with your own investment strategy. We live in a world where everybody is actually like, sharing their opinions, sharing what they think, and it's great because you can actually learn from people that know exactly what they're talking about. And it's okay to follow all that, go with the trends, understand what's going on in the stock market, keep up with what's going on in the business world, but you have to have your own strategy that caters to your risk appetite, caters to your financial situation, caters to really all the needs that you have. And if the stock market isn't the right investment vehicle for you at this time, schedule a different time where you might reconsider that decision. But unless you have your own strategy that works for you, considers your personal needs, you're just going to feel frustrated, because I think for the most part that the stock market is more of a psychological game and less of a numbers game. So it can mess with your psychology, because there are days you will wake up and everything is red, everything is low, and it's probably all the money that you had in your savings, you put it in the stock market and you feel like you've lost half of it, if not all of it. If that wasn't your own personal decision, you're going to be extremely frustrated and so stressed out, and that will make you make decisions that are really poor for your financial situation. So you have to sit down, look at your financial situation, come up with a strategy, decide that I am going to put $20 in the stock market every single month for the next 12 months. That is what I'm comfortable with, and stick to that. Don't feel the need to put $1,000 today or $500 the next day because you saw something in the headlines, because I truly personally believe that if it's already in the headlines, it's a bad investment, because at that point it's probably overvalued. So follow the headlines to learn and to educate yourself and to keep up with what's going on, but have your own strategy, have your own plan, and decide on what works for you and your financial situation. So we've come to the end of this video. I hope that if you are just really starting to think about investing in the stock market, this video has been helpful in helping you to really think about the things you need to put in consideration. And if you're already investing in the stock market, good luck, you know how it is. I hope this video has been helpful in reminding you of some of the things that you thought about when you initially started investing, or some of the things that you actually should be thinking about right now. If you haven't yet, please hit the subscribe button and let's grow this channel together. And make sure to like and share and subscribe. Bye!